Most people spend their entire lives focusing on how to grow their money, but at our firm, we spend just as much time focusing on how to keep the IRS from taking it. You often hear about diversifying your investments, but not enough talk is had about diversifying your tax buckets. Today, I'm going to briefly go over the 3 buckets where your money can live. To help illustrate my points, I have a few glass jars here to help you visualize what I'm trying to describe. I have my wages over here, and I have the 3 different buckets right here. The first bucket, or bucket number 1, is the tax deferred bucket. We have it right here. This is by far the most common bucket that we see filled up, and it's where your 401ks, your 403bs, and your traditional IRAs live. These accounts were actually born in the 1970s after a wave of corporate pension failures left workers with nothing. So Congress decided, hey, we want you to save for yourself instead of relying on a corporate promise. Now, if you're auto-enrolled in your employer's retirement plan, you're likely deferring money right here. And the major benefit is that if you put your wages in here, the IRS doesn't tax a single cent. They also don't tax the growth for many years. You're just hoping that when you retire, you'll be in a lower tax bracket. So you're essentially just kicking that tax can farther down the road. Your money, what happens is it goes directly from the wages jar, it avoids the federal tax and goes right into this jar. And it looks something like this. We have our wages, we're gonna bypass the IRS, and we're gonna dump it right into this jar. And then you also will have some investment growth over the years right there. But the IRS isn't patient forever. Back in the 1980s, they realized people were letting this money grow indefinitely. So back in 1986, they created what is known as the required minimum distribution, or the RMD. They basically said, we gave you a tax break, but now we want our cut. So in 2026 and forward, once you hit age 73 or 75, for some, the IRS forces you to take a scoop out and pay the tax. Even if you don't need the money, you have to pay the IRS. And remember, the entire scoop is taxed as ordinary income tax. Just like your paycheck, if you need to take these funds out prior to 59.5, you may be subject to an additional 10% penalty in addition to the ordinary income tax. So what that looks like is, here's your RMD. And we're gonna pay a little bit of tax. So let's move on to bucket number 2. All right, so bucket number 2, this is the after-tax bucket. We're gonna pour our money that's been taxed from this into this bucket number 2, which is the taxable bucket. This consists of your non-retirement accounts, standard savings, CDs, brokerage accounts, and any general investment accounts. This is your now money. You've already paid income tax on these assets before they entered this bucket. The really nice thing about this bucket is it's less restrictive than any retirement account when needing the funds. And any long-term capital gains could be subject to a lower tax rate. The downside of this bucket is you pay tax as you go. And so we have our bucket here, and over the years, we're gonna have some investment growth. Every time this bucket earns interest or pays a dividend or you sell a stock for a gain, the IRS is going to take a small annual scoop. So, hey, we saw that growth, we want some of this money. So they're gonna say, give us some of that money, boom, you're gonna pay the IRS. It's a slow leak that makes it harder for your money to build momentum. Again, the upside, unlike your retirement accounts, this jar is always unlocked. You have total access to it whenever you need it. And finally, we have my favorite bucket, the tax-free bucket. The tax-free bucket can also be called the after-tax bucket. And this is where your Roth IRA, your Roth 401k, and your HSA live. You pay tax on these wages up front before they get in there. And it looks something like this usually. We have the IRS, they're gonna take their 25%, and then we're gonna dump the remaining into that tax-free bucket. And once the money is in here, the IRS is locked out. No matter how much it grows, you never have to sprinkle a single coin back into the IRS bucket. You can get into this bucket through a Roth contribution in your employer's 401k, where the limit is $24,500 for 2026, or a direct Roth IRA contribution if you're under the income limitations. If you're over the limit, we might look at a backdoor Roth contribution or a Roth conversion. And let's not forget about the HSA. In 2026, you can put up to $4,400 for yourself or $8,750 for a family. So what's great is we're gonna add a little investment growth because over the years, this money is gonna grow. And look at that. Tax-free growth. And every penny of that market gain belongs to you, not the IRS. Now, a couple other nice features. You can always take out your contributions tax-free if you need them. And unlike your traditional IRA accounts, there's no RMDs in the future. The money can sit in here for years and continue to grow 100% tax-free. So in summary, I want you to take away a few key points from this video. We have 3 jars. and they're right here. A balanced retirement needs a mix of all three of them. We often see clients come in with millions of dollars sitting in the first jar here. And effectively, it just gives the IRS a massive say in their future lifestyle. If tax rates go up in the future, you'll be handing them over even more change instead of just keeping it for yourself. So think about what bucket your current retirement contributions are going into and make sure it actually makes sense for you. For instance, if you're currently in the 12% tax bracket, it likely doesn't make sense to defer that tax. Why kick a 12% tax bill down the road to a future where rates could be way higher? When your financial advisor builds out your retirement plan, have them also build out a lifetime tax plan. You need to understand if your tax rate will actually be lower in the future or not. More often than not lately, we are seeing that clients won't actually be in a lower bracket during retirement. Lastly, if you have a large amount of money sitting in bucket number one, make sure you are doing an annual analysis to see if a Roth conversion makes sense. And this is extremely important right now with the tax rates at these really as low as they're ever going to be, in my opinion. Now, if you've built up a significant amount of assets in one or more of these buckets and have questions on how to rebalance the buckets, give us a call here at Hicks Mann. Let's make sure you're the one who keeps what you've worked so hard to build. I'm Matt Mann, and thanks for watching. And click subscribe.